Hello friends, welcome to the Tally Customer Services. So in this video we will see accounting questions and answers that is asked in the interview for record to report process R2R record to report. Okay, so let's start the video. So our first question is what is accounting? So this question is a basic on accounting and finance interviews. So accounting is the process of recording, classifying, summarizing of all the transaction and event which are in the terms of money and interpreting the result of. So basically there are three parts in the accounting. One is recording, second is classifying, and the third is summarizing. So regarding what we will do, we will collect the data and we will post the journal entries. We will post the journal entries for purchase, sales, payment, receipt, contra, journal vouchers. Okay, so after that we will post it to the ledger posting. We will do the ledger posting, and after ledger posting we will prepare the financial statement like balance sheet and profit and loss account. Okay, so next question, what is accounting concept? Accounting concept, so there are basically 5 to 6 accounting concept. The first is business entity concept. What is business entity concept? A business and its owner should be treated separately as far as their financial transactions are concerned. If any cash or goods owner is taking from the business for the personal use, it violates the business entity concept. Business entity concept says that owner expenses is separate and business expenses is separate. Owner profit is separate and business profit is separate. Okay, next question, money measurement concept. What is money measurement concept? Only business transactions that can be expressed in the term of money are recorded in the accounting. If any transactions happens which you cannot measure in the money, you will not record those type of transactions in the business transactions. You cannot consider that business transaction. Okay, next question is dual aspect concept. Every business credit a corresponding debit is made. The recording of transactions is complete only with this dual aspect. So, this accounting concept says that every transactions you pass and debit, same amount you have to credit in the same entries. Every your debit should be credit. Going concern concept, so in going concern concept it is assumed that business will not collapse and will run eternally in the process. Cost concept, the fixed assets of the business are recorded on the basis of their original cost in the first year of accounting. So this concept said if you buy any machinery which cost is 1 lakh rupees today, and maybe this cost will 2 lakh rupees in next financial year. So in the next financial year you cannot show that machinery cost is 2 lakh. It should be always your purchase price. Next question, accounting year concept. So accounting year concept says that every year you should start from and you should start in the date should be fixed. Every country is following this rule that accounting period concept. So in India, accounting period start from 1st April to 31st March of next year. Suppose this financial year is 1st April 24 to 31st March 25. Okay, matching concept. This principle dictates that every business entry of revenue recorded in a given accounting period, an equal expense entry has to be recorded correctly, calculating the profit and loss in the given period. So here we will see that every expenses and income should be recorded in the same period when they incurred. Realization concept. According to this concept, profit is recognized only when it is earned. In advance paid is not considered as a advance paid or received is not considered as a profit until the goods and service have been delivered to the buyer. That is the realization concept. Realizing the income or expense. Accounting conventions. So there are four accounting main concern are there. Conservatism, consistency, full disclosure, materiality. Okay, what is conservatism? Conservatism is the conventions by which when two value of a transactions are available, the lower value transactions is recorded. By this convention, profit never be overestimated and there should always be provision for losses. Next, consistency. Describe the use of the same accounting principle from one period of an accounting cycle to next accounting cycle so that next accounting cycle so that the same standard are applied to calculate the profit. Materiality concept. What is materiality concept? Materiality concept means that all the material facts should be recorded in accounting. Accountants should record the important data and leave out insignificant information in the financial report. Next is full disclosure. So this is the another conventions. It entails the revelation of information both favorable and detrimental to a business enterprises and which are of the material value to creditors and debtors. So our next question is golden rule of accounting. So the golden rule of accounting are personal account, real account, and nominal account. So first of all is personal account. What is it? Natural person. Natural person means like a name of the individual. Ramu, Krishna, Harish. Artificial person. Artificial person means like bank. Artificial persons is like your bank, institutions, companies, capitals, bank, institution, capitals, sundry debtors, sundry creditors. These are your artificial person or any company name from which we buy and sell. Institutions, debtors or customer, debtor or customer, company name. creditor or vendor. Creditor or vendor. Next is the representative person. Okay, representative person is nothing but the prepaid expenses, outstanding expenses, prepaid expenses, outstanding expenses, income, advance income, and advance paid. Impersonal account. So in the impersonal account, there are two accounts: nominal account and real account. Personal account, impersonal account, real account. So real account are like your land, building, plant, machinery, land, building, plant, machinery. I will just take it down so it looks good. It look clear. Real account and nominal account. So your land is a real account, building is a real account, plant is a real account, machinery, furniture, etc. Nominal account are salaries, rent, insurance, wages. So what is personal account? Rule, golden rule for personal account. Golden rule for personal account. Debit the receiver, credit the giver. Debit what comes in, credit what goes out for real account. Okay, now it looks clear and nice. Debit the receiver for personal account, golden rule. For personal account, golden rule is debit the receiver, credit the giver. Personal account golden rule, debit the giver, credit the debit the receiver, credit the giver. For real account, golden rule is debit what comes in, credit what goes out. For nominal account, golden rule is debit expenses and loss, credit income and gain. Okay, next about record to report process. About record to report process. What is record to report? Record to report is a finance and accounting management process, or we can say accounting and finance management process that involves the collecting the data, processing the data, and representing the data in a financial report. That process is called your record to report. A record to report provides the strategic, financial, and operational feedback on the performance of the organization to inform the management and stakeholder. In this process, the major activities is the journal entries, and it includes your month end journal entries. And the journal entries, there are many kinds of journal entries: for adjustment journal entries, reclass journal entries, provision journal entries, ad hoc journal entries, prepaid journal entries, etc. Okay, next question is balance sheet reconciliation in black line tool. Only this is only for the SAP, only for SAP candidate. Only for the SAP candidates, or only for the SAP candidate, SAP candidates. So the reconciliation, balance sheet reconciliation in SAP, they process the intercompany reconciliation in ICM tool, book closure, month end close, and open activities reporting in Hyperion Financial Management tool. This question is only for SAP candidates. And next is what are record to report process? What are the stages in record to report process? What are the stages in record to report process? So the first stage is collection, data collection, collecting the data. So in the data collection, we will collect the invoices, we will connect the bank receipt, bank payment, and the second stage is we start journal entries. We will record the journal entries. And next, in month end, we will record the adjusting journal voucher, adjusting journal entries, journal voucher. Then, if the company has multiple branches, we will combine the balance sheet or consolidation. Consolidation, we will combine the balance sheet or profit and loss account. Consolidation, we will also call the consolidate. Consolidate the balance sheet, profit and loss account. Consolidation or merging, we can tell the merging the data. What are the benefit of record to report? So the benefit of record to report is strategic decision making. It helps in strategic decision making. It helps in strategic decision making. It helps in compliance ready. Record to report helps your compliance will be ready on time. And another benefit of the record to report is the tax reporting. A record to report helps in the tax reporting of the companies. What is intercompany? What is intercompany or intercompany reconciliation? So intercompany is nothing but one parent company and multiple child companies. Any transactions is happening from child company to parent company or between the child companies, that type of activities is called the intercompany. Intercompany and intercompany reconciliation. Why do we do the intercompany reconciliation? To match the books of the payables and receivables. Suppose head office paid the expenses of branch office, so the branch office accounts receivable is whatever the receivable is there, it should be equals to the head office payables. It should not record more than that. Suppose if 10,000 rent paid from the HO office, in branch office they cannot record 15,000 expenses. Okay, so that is the intercompany reconciliation. And intercompany reconciliation or consolidation also eliminate the profit of the child companies. If one company having the profit of 1,000 rupees and second company having the profit of 1,000 rupees, so in intercompany we will consolidate and the profit will become the 2,000 as a whole. Intercompany process only for the experienced candidate. So these were the introduction of record to report process. In the next video we will see the journal entries for record to record videos.